Thank you and welcome back. Welcome back to this video series on which is a guide on how to sell your business to your employees with a better Monday. So for the next stage of this journey, we're going to be talking about is what is the actual company structure that we use for these transactions, because it's not typical. So we do want to stress that this is not typical, but the structure that we use is one that we've chosen to be really pragmatic about. We're leveraging local laws, local legal and taxation systems to be able to get the best outcome for everyone involved. So this basically starts with us acquiring the company. Okay, we do that usually a mix with sort of senior debt and also equity from a better Monday. Sometimes we're also including seller financing, and we always include a little bit of seller equity in the form of a rolling that over into this new company. Once we complete the transaction, what we then do is we set up an employee cooperative, and the employee cooperative then takes out a loan from the company for the equivalent of 30% of the business. And so then the employees via the employee cooperative then own 30% of the business. Okay, that way the reason why we need the loan is so the transaction can happen at a net asset value of zero, because that means that the employees don't have a taxable event. So they've been able to get their shares of the company without having to outlay any money or have a burdensome tax bill. And this is a key part of our model and something that we're very proud to be able to have created so far. So going on to the next stage. So what we're then hoping the company makes considerable amounts of profit and continues on its journey of making profit like it has been doing so far. We're going to use that to pay down the debt. We're then going to use it to retire the seller's rollover equity. So retire your equity over time. Again, we're hoping this happens in 2 to 3 years. We're then going to retire our equity over time as well, so that once we've done doing that journey, then the employee cooperative is the only shareholder that's left on the cap table of the business, meaning that the employees now own 100% of the business. So a common question I get asked now is, how do we decide which employees get what within the cooperative? So for us, what we do is the employee equity is calculated annually, And so what we do is we calculate based off people's salary, based off people's tenure and seniority, and that forms a calculation. And so what we do is we find out what that is, and so that gives us a proportional ownership for that calendar year. We then look at that compared to a valuation of the business, and that total is then sort of tracked within what we're calling a collective capital account. That for each individual, their value is tracked within their own individual capital accounts, so that when someone is to leave the business, once they've, say, moving into retirement or moving on to other opportunities, and if they're fully vested, what happens as they depart, their equity is added as a liability to the collective capital account. And then we will utilize the future profits from the cash from the business, the excess profits from the business to pay out those employees over time. So that ultimately is reducing that collective capital account liability. So this is something that this structure enables us to pay these employees out on a first in, first out basis. So we're rewarding people with the tenure, but also ensures that this does not provide a burdensome challenge for the company. There isn't a huge obligation to pay out if there's a mass exit event, because it only pays when there is excess cash flow available. And the other part that I truly love about this model is it also does align incentives for those employees to look after the future of the business. Because if the current employees, they could make profit distribution for their own gain and to pay out their own individual capital account. But that would mean that the future companies would not be able to pay down the rest of their capital accounts. So that means they're going to have a real issue of getting their own liquidity from all the fantastic assets that they've been building. So this is very similar to the models that are being deployed in Denmark and in Slovenia, when it's really taking the best of the models that we see in other parts of the world, and sort of hopefully we're able to replicate. And so we're able to replicate that here too. So thank you for this element. The next one next video, we're going to be diving into what happens post the transaction. Okay, we'll see you there.